Here we're going to look at a consolidation with less than 100% interest, and it's going to include goodwill. So for our example here, the parent company, Corporation A, is going to buy 80% here of Corporation B, the subsidiary, and they're going to pay $688,000 for this 80% investment here in Corporation B. So we have to determine the total implied fair value here. So we do that by using our arithmetic here. So we take the 688,000 here and divide it by 80% or 0.8 here, and we get $860,000. That's the total implied fair value here for the subsidiary Corporation B. So next we have to look at the balance sheet here, and what we have to do is we have to determine the fair value for all the assets and the liabilities that Corporation A is going to acquire here in this acquisition. So we know the book value. I've got those shown here. That's what corporation or the subsidiary has on their records here, but we have to determine the fair value, or we have to estimate the fair value for these assets and liabilities. So once we've done that, we can determine the fair value of our net assets. And looking at our total assets here, their fair value was $920,000 less the total liabilities, their fair value here of $160,000. We get our net assets here of $760,000. So to determine our goodwill, we take the implied price here of $860,000 less the fair value of our net assets here of $760,000, and then we have a goodwill value here of $100,000. Okay, next let's look at our distribution schedule here, and starting with the fair value of the subsidiary. First we'll concentrate here on the 80% that the parent is purchasing here of the subsidiary, and that was for $688,000. So the total value here, fair value for the subsidiary would be $860,000. Now that's the implied fair value, and that's calculated by taking the $688,000 here paid, divide that 0.8, and you get $860,000. So the remaining amount here would be the 20% here of non-controlling interest for $172,000. And then next we have to subtract out here the book value of the total equity being acquired here from Corporation A or B here, the subsidiary. So that here from the balance sheet, total equity here for the common stock and the retained earnings here is $335,000. So then we have to proportion out this total equity here between the parent and the non-controlling interest. So looking at the parent here, you take 80% times $335,000 and you get a book value here of $268,000. And then for the non-controlling interest, you take 20% times this total equity here of $335,000 and you get the book value here of $67,000. So then we have to determine the excess of the fair value here over these book value amounts. So looking at the implied fair value here of $860,000, so that's the total value of the subsidiary, and then the excess of fair value over the book value would be the $335,000 subtracted from the $860,000, so you get an excess here of $525,000. And then for the 80% here that the parent is purchasing, you take the $688,000 less the $268,000 book value, you get $420,000. And then for the non-controlling interest here, taking the fair value here, $172,000 less the $67,000 book value, you get $105,000 here for the non-controlling interest, and that would be the excess of the fair value over the book value. Okay, next let's look at how we divide up here the goodwill here in this acquisition. So looking at our value analysis schedule here, we'd have the subsidiaries fair value, the implied fair value of $860,000 here, plus the parent's portion of $688,000, and then the non-controlling interest of $172,000. Now, taking the fair value of the net assets, we have to proportion that up here between the total fair value of $760,000, and then the parent's portion would be $608,000 or 80% of that, and then the non-controlling interest would be 20% or $152,000. So taking the difference here between the fair value here of the subsidiary in this case less the fair value of the net assets acquired, the goodwill here was $100,000. That's what we had previously calculated here. And then taking the parent's portion here, or 80% of that here, the difference between the fair value here of the subsidiaries, 80% portion, that was the price paid here, less the fair value of the net assets acquired of $608,000. We get goodwill here of $80,000, and then the non-controlling interest just would be the $172,000 here, the fair value portion, less the fair value of the net assets portion here of $152,000, and then our goodwill here would be $20,000 assigned to the non-controlling interest. Okay, next we have to determine the adjustments that we have to make to the subsidiaries accounts here in this consolidation. And we'd have to base that on the difference between the book value here for the subsidiaries assets and liabilities here and the fair value that we estimated here for these assets and liabilities. So with taking the difference here between the two, those are the adjustments that we'd have to make here. And we also have to include goodwill that was in this consolidation process or for this acquisition here. So looking down here at our adjustments accounts, we determined that these were the changes here between these asset and liability accounts. And also we have the goodwill amount here of $100,000. So we total up those adjustments that we have to make, and that would be $525,000. Now that has to compare with our distribution schedule here for the total excess of fair value over the book value here for this subsidiary, and that was $525,000. So those two amounts have to compare here, and that is the total. $525,000 are the total adjustments that have to be made here to the subsidiary accounts or the subsidiary based on its fair value. Okay, next looking at the journal entries that we're going to have to make for this consolidation here. So let's look at our distribution schedule here and look at this parents portion here of $688,000. We're going to have to eliminate the book value here of $268,000 plus the excess here of the fair value over the book value here of $420,000. So this $268,000 book value here, that is 80% here of the total equity that we're acquiring here. So 80% of this total equity here between the common stock here and the retained earnings here, dividing that up, it's $268,000. So in our investment in our sub here, we'd have to take and eliminate $268,000 here. And our total amount here was, debit amount here was $688,000. And then the difference here between the balancing amount here would be $420,000. Now that was the excess of the book value or the fair value over the book value here for the parent here. And then also for this subsidiary, we'd have to eliminate the 80% here of the equity that it's being acquired, that $268,000, and then that would be divided up here between the common stock and the retained earnings here. So that would be eliminated here for $268,000. And then for the non-controlling interest, that would go to retained earnings here, the $105,000 here of the fair value over the book value. That would be $105,000 here. And then the only other things that have to be done here is we have to adjust our subsidiary accounts here for the changes here in the assets and liabilities and also the goodwill here. So what we'd be doing is taking the fair value or of the subsidiary accounts, which includes these adjustments here, and we'd be adding them to the carrying or the parent's assets and liabilities. In summary, we accounted for this total $525,000 excess here by eliminating the $420,000 here investment in the sub, and also the $105,000 non-controlling interest here. We credited, we increased our retained earnings by that amount. And then we also eliminated this 80% here equity here of the subsidiary here for $268,000. And that was also reduced here by $268,000 for the investment in the sub. So that accounted for our total investment in the sub here of $688,000.